Buffett will step down as Berkshire's CEO. Under his leadership, it didn't matter at what point you would have invested in Berkshire. Buffett's trillion-dollar conglomerate wins every multi-year comparison with the S&P 500. So whenever one thought, it's too late now, Berkshire proved that's not the case. Will that change now that Buffett retires?
There's no better capital allocator than Buffett, but what might be underappreciated is how well Berkshire is structured and how well it will run without him at the top.
We looked at all the business segments today, and I have no doubt that Berkshire will continue to do Berkshire things, even without Buffett as CEO.
All right, folks, it took us a while, but the day has finally arrived. We will be talking about the company that stands for value investing like no other. And today we are talking about Berkshire Hathaway, Warren Buffett's conglomerate, and the inspiration behind how both Daniel and I personally invest in many ways. And I'd like to think that we're not only doing this because we had to cover Berkshire at some point, but because it might actually be a good time to consider investing in Berkshire. And I say that because the stock is only up modestly year to date, while the S&P 500 has gained almost 30% since those April lows from the tariff announcements. And in that time, Berkshire is actually down about 5%.
And we shouldn't forget that it's the year when Buffett actually leaves the CEO position after exactly 6 decades at the top of what you can call the most successful conglomerate in the world.
It feels like yesterday that you and I were sitting in the CHI arena together in Omaha with thousands of other people just giving him a standing ovation after he made that retirement announcement. And I'm kind of embarrassed to say, but I think I might have had a tear come to my eye in that moment. And there's just something so beautiful about 40,000 people applauding a man who has not just made them tons of money over the years, but also taught them so much about life and business too, including ourselves. So, and there are so many ways in different things we could go about covering in this conversation today. So I guess I'll just ask you where you want to start. I mean, maybe a look in the rearview mirror of Berkshire's history could be appropriate.
Yeah, honestly, it wasn't easy to think about what exactly I wanted to talk about today, because obviously we'll get to the investment case, but beyond that, there are so many anecdotes and stories that one could tell. And I know it's the same for you, but I've read so much on Buffett in the last, I think, 8 years that my mind is just full of all of these anecdotes. I actually stopped reading a lot of the typical value investor and Buffett literature just because I felt that after some years, there was a diminishing return to picking up yet another book on value investing. Buffett once said that value investing either clicks with you instantly or never will. And I think that's true. And still, one unfinished project of mine is to read through all the Buffett shareholder letters. I read the vast majority of them, especially the early ones, but there are still some years that I've not yet finished but want to.
You know, it's funny you mentioned that. I had a friend do that recently, and he told me, even after having gone to Berkshire meetings for years and having read a scattering of Buffett's letters, sitting down and actually reading from the very first letter through till today, it's just a totally different experience. And he found it very rewarding. And my goal at some point is to eventually do the same. The letters are packed with so much folksy wisdom and charm, insights about life and psychology. And then of course, the case studies on Berkshire's different investments over the years. And I know they've played a big role in shaping who we are as people and investors today. And it was actually from listening to Preston and Stig talk about Buffett on our sister We Study Billionaires podcast years ago that I first discovered value investing. So it's kind of a surreal moment for me to now be working for the Investors Podcast full time and doing a podcast on Berkshire myself alongside you.
It feels like a full circle moment, not only for you, but my story is pretty much the same. I still remember listening to Preston and Stig in, I think it was 2017, and I feel like I've consumed 100 hours of podcasts on Buffett and Munger just by listening to the two of them, which didn't make it prioritizing for this episode any easier, I must say. And I thought about, okay, how do I start this? Will I talk a bit about Buffett's history? But then I quickly realized that if we do that, our listeners would need to sit through a multi-hour long episode that might feel like a Berkshire Hathaway shareholder meeting, just without all the excitement and, well, of course, also without Buffett. And I want to spare that not only for the audience, but also for us. It's not like we're doing any hard labor here, but hours of recording can also be draining at some point.
Yeah, just as context for the audience, Daniel and I have this very bad habit of basically holding a full meeting before we actually start these podcast recordings. And sometimes we'll sit here and talk for an hour or two before we actually record, which can take another 2 hours. So it's exhausting, but we put a lot into these episodes for you guys.
Yeah, so to prevent anything like this today, I will focus on the history of Berkshire, and Buffett anecdotes will, I think, just come up naturally in between anyway. And it's needless to say that Berkshire without Buffett doesn't really work. At least it didn't in the past. I would say for Berkshire shareholders going forward, we hope that changes. So by now, it's somewhat public knowledge that Berkshire didn't start as a holding company. Its roots actually go back to the late 19th century in the form of two New England textile companies, which were Hathaway Manufacturing and Berkshire Fine Spinning Associates. And in the mid 1950s, those two companies merged, and that's how Berkshire Hathaway, at least to some extent how we know it today, was born.
And yet that wasn't the Berkshire Hathaway that we do know today. As you said, the two companies that merged were textile companies. And that's also the type of business Berkshire Hathaway would remain for years to come, which certainly is not what we think of when we think of Berkshire now. The merger was meant to help these two struggling companies survive after having been squeezed by cheaper Southern producers and overseas competition in textile manufacturing. But it didn't help, and the company kept declining from there. And I guess some things never changed. Textiles were a tough business to be in the 1960s, and it still is. And after looking at quite a lot of retail businesses on our show, we can attest to that. And so it's safe to say that we probably would not have added pre-Buffett Berkshire to our intrinsic value portfolio just because textiles were such a bad industry to be in structurally.
Well, the good thing for Berkshire, though, was that the young Warren Buffett wasn't yet looking for these high-quality companies. So a struggling textile business trading well below book value was exactly what Buffett would be interested in. It was one of his typical cigar butt investments. And in his own words, a cigar butt is, quote, kind of a pathetic company that sells so cheap that you think there's at least one good puff left in it. And what initially caught Buffett's attention was Berkshire Hathaway's capital allocation, because as you said, the company was in decline, so it had to close plants from time to time. And whenever that happened, it often used the liquidation proceeds to then buy back shares. And in 1962, I think, Buffett started buying Berkshire stock at almost a third of book value based on the thesis that Berkshire would continue to sell plants and then buy back shares with the cash. And in theory, his investment thesis worked out, but then something happened that made Buffett quite angry and caused him to make a decision that many years later he referred to as his probably biggest investment mistake ever, costing him around $200 billion.
This is one of my favorite stories, but for the audience, just tell us what happened.
Well, Buffett eventually held 7% of Berkshire, and he knew that at some point Berkshire's CEO would reach out to him and ask him at what price he would be willing to sell his shares. And Buffett let him know that he would sell them for exactly $11.50. And based on his initial entry of $7.50, that would have been a nice and quick profit of, about 50%. And Berkshire's CEO agreed, and Buffett thought, okay, well, then the Berkshire chapter is soon to be closed. But when the day came and he received a letter with the offer to sell his shares, the price Berkshire offered was not $11.50, it was $11.37. And Buffett was so upset that Berkshire CEO didn't hold his promise of $11.50 that he refused to sell any of his shares, and instead he doubled down and bought even more Berkshire stock. And just a year later, he owned a third of the entire Berkshire company and took control over the company in a board meeting where the former Berkshire CEO, Seabury, was fired. This might sound like a cool revenge arc at first, but it's not really the calm and rational manner that Buffett is usually associated with, and he acknowledged it himself, saying, quote, "Through Seabury's and my childish behavior, he lost his job, and I found myself with more than 25% of my partnership's capital invested in a terrible business about which I knew very little. I became the dog who caught the car."
My takeaway from that story is that while this isn't the usual Buffett behavior that he's become famous for, with that sort of unmatched stoicism and calmness about him, even when the financial world is melting down. But of course, Buffett was a relatively young man when this all went down. So I think it's easy to forget just how long Buffett's career has been. I mean, this was over 6 decades ago, and how much he's evolved naturally along the way. He had already been a successful investor for years when he basically completely changed his strategy from investing in cigar butts to, with the help of Charlie Munger, famously, focusing instead on quality companies at fair prices, which is really quite literally the opposite of cigar butt investment. So there's an open-mindedness to him that I think is really impressive. Even after crushing the markets for a decade or so, it would be so easy to lean into very rigid, dogmatic thinking of, this is what I do because it's worked, and you don't want to drift too far from how you've been making money. But we saw Buffett ultimately reinvent himself after several years of running Berkshire. And I'm probably getting ahead of myself, so I think I'll take a step back, not to ruin the story. But how about we just take a moment to linger on one of the really interesting comments you made a minute ago, and that was how doubling down on Berkshire was, ironically, one of Buffett's biggest mistakes in his mind. And to anybody just hearing that, I mean, that's going to sound crazy in hindsight, but tell us why Buffett feels like some of these early decisions were, in fact, mistakes.
Well, the impulsive decision to take over Berkshire was only the first mistake. The biggest mistake, which ultimately also explains why Buffett thinks he lost hundreds of billions of dollars here, was the first acquisition he made through Berkshire Hathaway. Buffett was, and he still is, an insurance specialist, and it's not surprising that, therefore, his first big purchase was also an insurance business. The company was called National Indemnity, and it was led by a friend of Buffett who wanted to sell it explicitly to him personally. And that's where Buffett said he probably made the biggest mistake in the history of Berkshire, because instead of buying it for his partnership and basically him personally, he bought it for Berkshire Hathaway. And the problem is that Buffett himself at that point only owned 60% of Berkshire. Said differently, that means that 40% of this high-quality insurance business is now owned by legacy shareholders of Berkshire instead of Buffett and his partners in this partnership. Considering the compounding of capital under Buffett, the quote-unquote loss of 40% of National Indemnity was quite expensive in the long run.
I think Buffett has mentioned that even decades later, he has really no idea why he bought National Indemnity for Berkshire. I mean, it just doesn't make sense. But to focus on the more positive aspects of that acquisition, we both know that buying this small insurance business had really a significant impact on the future of Berkshire that almost would have made their success otherwise not possible to the degree that things have worked out. And I say that because it introduced float into Berkshire's operations. And that's ultimately a huge part of the success of Berkshire. For anyone unfamiliar with the concept, float is money that doesn't directly belong to the insurance company, but it's at the company's disposal because of the insurance premiums that customers pay in advance of later submitting insurance claims. So there's this mismatch that occurs where insurance companies are holding the cash from premiums up front before they need to be paid out yet. And in that time, the insurance company can earn interest on holding other people's cash and maybe even invest some of that capital into companies. But we should probably just let Buffett explain it himself. So let's do that.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us. It's like a bank having deposits. A bank has deposits. The money doesn't belong to it, but it holds the money. Now, when a bank holds deposits on everything except demand deposits, there's an explicit cost and interest rate attached to it. And then there are the costs of running the system and gathering the money, which is also must be attributed both to demand and time deposits. So there's a cost to getting what they would call deposits and we could call float. In the insurance business, a similar phenomenon takes place in that policyholders give us their money at the start of the policy period, and therefore we get the money paid in advance for the product. And secondly, it takes time to settle losses, particularly in the liability area. If you bang up a fender on your car, it's going to get settled very quickly. But if there's a complicated injury or something, it may take some years to settle. And during that period, we hold the money.
And for the greatest capital allocator of all time, holding money at literally no cost is just a very powerful concept. In fact, as we will see later, Berkshire is actually getting paid to hold and invest that money, because Berkshire's insurance companies are among the small group of insurers that actually earn underwriting profits instead of losing money. So it's not surprising that over time, float has become Berkshire's core funding option, and more of the reasons Berkshire could compound capital without requiring equity dilution or debt. in the years after acquiring National Indemnity, the float capital funded a series of acquisitions. One of the most notable companies was Blue Chip Stamps, and that matters to our story today. Well, because it was the first major deal that Buffett and Munger did together. At the time, Munger still had his own partnership where he managed money for, and Blue Chip Stamp was a trading stamp company where retailers basically handed out stamps with purchases, and customers could then later redeem them for merchandise. And the model generated a form of float very similar to what insurance companies do, and customers often held these stamps for years or they never redeemed them at all, giving Blue Chip a pool of investable cash in the meantime. And like many of the businesses Buffett invested in the early days, Blue Chip eventually went bankrupt, although it was a better business than all of the cigar butts Buffett usually invested in. But not every investment can work out in the long term.
It's not really a secret that Munger nudged Buffett to invest in better businesses than he has in the past, as I alluded to earlier. And the best known example of that is See's Candy, which is a company they actually bought with the float generated by Blue Chip Stamps. And it's known as being the investment that showed Buffett how much easier it is to invest in great businesses instead of having to continually look for these cigar butts.
Right, although See's Candy wasn't even that expensive. See's earned about $4 million in pre-tax profits, and Buffett and Munger paid about 11 times earnings and 3 times tangible book value for the business. And for Buffett, 3 times book felt like committing a value investing crime. He mentioned how it made him almost feel sick paying that price, and both of them still were convinced by just the strong brand and pricing power of the business. And I think we mentioned See's Candy before, briefly in our Hershey episode, when we talked about how candy brands tend to be successful only in specific regions. The same thing was true for See's Candy as well. It was very successful on the west coast of the US, but it failed to expand any further. On the other hand, the candy brands also failed to take See's market share in the west coast. So yeah, you could say that See's Candy and Munger's influence turned Buffett's investing approach around at this point. Although I gotta admit, and Munger said it himself, Buffett obviously knew about the strength of investing in strong brands and businesses, but it's a fact that he achieved his best ever returns buying and selling those ugly cigar butts. He had to change this strategy at some point because he managed too much money to keep investing in micro and small cap companies. And I think that's at least 50-50 is why Munger nudged him into that direction, and also why Buffett knew at some point it just has to happen. I mean, Joe Greenblatt once said, quote, "The great thing about investing in small caps is that the people who get good at this stuff get wealthy, so they can't look at small caps any longer. They go to the large cap." And I mean, no one was as good as Buffett was, so it was a matter of time until he had to change his strategy.
And I think what Greenblatt really means there is that there's a good reason why small cap stocks can remain this inefficient market indefinitely, where really astute investors can differentiate themselves. Because as you said, the best at picking these types of more obscure stocks end up compounding their wealth and their returns to a point where they, by definition, have to invest in bigger companies. I mean, otherwise it would be impossible to allocate hundreds of millions or billions of dollars that they might manage, which opens the door to the next generation of investors to come into the space as sort of these legacy people graduate and move up to bigger fish. So I know you've dabbled in small caps a little bit, Daniel, but on the show here, we've obviously opted to focus really on Buffett's own lessons and focusing on larger, more stable, high quality companies and trying to get them at a fair price, which in our portfolio, you'll see that it ranges from companies like Alphabet to Adobe, Nike, and Ulta. So none of these would fit the definition of cigar butts.
I mean, ultimately, those are the type of investments that define Berkshire. Businesses like Geico, for example, it's another insurance company and one that's often used to argue in favor of quality businesses because famously, Benjamin Graham, who was Buffett's teacher at Columbia and is also referred to as the father of value investing, he made more money with his Geico investment than he ever did buying and selling cigar butts, which he was even more famous for than Buffett ever was. And a lot of those great compounder stories still seem like there's somewhat of a survivorship bias there. Geico, for example, was almost bankrupt in the mid-70s. That's when Buffett stepped in, buying a large stake for Berkshire at pretty distressed prices and helping to stabilize the business. That's pretty much a textbook example of what Buffett and Berkshire stood for in the decades later: permanent capital through using all the float they had from their businesses a strong willingness to act in a crisis, and a pretty long memory, because as I'm sure you know, Buffett first encountered Geico in 1951, so 25 years earlier, and when the price got very attractive, that's when he bet big.
And Geico was only the beginning of scaling up Berkshire's insurance business. I think you mentioned before that in 1970, Berkshire's float was around $39 million. And just 20 years later, it was $1.6 billion. And at the end of this last year, it was at $164 billion. And since Buffett and later Ajit Jain, who's hired to run the insurance businesses, they've always prioritized underwriting insurance only at a profit and to be able to walk away from business if pricing wasn't right, because Berkshire's underwriting has been mostly profitable over all those decades. And most insurance companies, for context, do not underwrite profitably. They pay out more in claims over time, typically than they take in upfront from premiums, but they make up that difference with interest from their float. So underwriting at a consistently profitable level is just a huge difference maker structurally for the business. And because it allows those float investments to keep compounding without needing to be touched. It's like letting your 401k just continue to compound without ever having to take any money out of it. And so in other words, Berkshire could not only invest the float, but they basically got paid to hold that capital. And most other conglomerates rely on debt and equity and therefore pay in one way or another for the capital that they invest. And I know we could talk a whole hour and maybe longer just about the insurance arm of Berkshire, but to get a full picture of the company, how about we zoom in on their expansion into retail, media, and manufacturing that we really started to see happen in the 1970s and 1980s. Even Einstein had blind spots. That's why modern science is built on the idea of peer review. Investing may be more art than science, but that doesn't make peer feedback any less valuable. The tricky thing is finding qualified people who are interested and willing to help vet your investment ideas. That's why we built the Intrinsic Value community. It's a place to connect, share ideas, learn, and get feedback. Nobody ever wishes they'd spent more time buried in spreadsheets, but connecting and building relationships with others who may be smarter on a topic than you, but who are also schooled in value investing, that's valuable. We make spots in this exclusive community available in cohorts every few months, and last time around, our 30 available spots filled up pretty quickly. If you're interested in our next cohort, which will be even smaller, you can join the waitlist at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. Look, every hunter, camper, and backpacker needs one of these. That is a Harvest Right freeze dryer, which lets you preserve your own meals and snacks. It's perfect for your next backcountry adventure or hunting trip. You can fuel your adventure with freeze-dried strawberries, bananas, pineapples, and even full home-cooked meals. No more relying on expensive store-bought, preservative-packed food. You can also preserve wild game with your Harvest Right freeze dryer. That's right, take control of your harvest by freeze-drying venison, elk, or fish, so you'll always have high-quality protein ready to go. And your pets will love the freeze-dried treats too, just like my dog Riley. Freeze-dried meals are lightweight and long-lasting, staying fresh for up to 25 years, yet they taste just as good as the day you made them. Whether you're hunting, camping, or prepping for emergencies, a Harvest Right freeze dryer keeps you ready for anything. It's like having extra cash in your portfolio to take advantage of downturns in the markets. That's how I think about it, at least. Learn more by visiting harvestright.com/investors. That's harvestright.com/investors. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout.
Yeah, so the 70s and 80s, Buffett and but then also Munger increasingly scaled down the old textile business that Berkshire Hathaway still, at least to some extent, was. And in the mid 80s, it was finally time they ended up closing the business altogether. And at the same time, these were some formative years for Berkshire. Besides companies like Blue Chip Stamps or See's Candies, Buffett bought businesses like the Washington Post, the Buffalo News, and also the Nebraska Furniture Mart. And the Washington Post investment was a good example of how Berkshire's philosophy in minority stake investments evolved. He bought a 12% stake in the company in the bear market of the early 70s. And Buffett promised Catherine Graham, who led the company at the time, that he would never purchase any more shares without her approval. Buffett admired her a lot for her business sense and integrity, and this became something like a blueprint for Berkshire's future minority investments. Find good companies with strong franchises and exceptional managers, and then partner as a supportive and trusted and also as a permanent shareholder.
There are a lot of great stories about Katharine Graham and Buffett. And she was the first female CEO of a Fortune 500 company, which, by the way, reminds me of when we covered Estee Lauder and talked about Estee being such a bright and confident leader in what was still a predominantly male-dominated world. And it was the same for Katharine, obviously, with the difference being that she didn't have that same confidence. And actually, she was almost really the opposite, actually. But Buffett knew about her talent and spotted it and really reassured and helped her navigate a pretty tough situation. And of course, the rest is history. She became one of the most influential women in American business history. And there's even a newly released documentary about her on Amazon Prime, and Buffett's in there as well. And also, I should say, the book, The Outsiders, which is a personal favorite of mine by William Thorndike, tells the story pretty well and goes through the relationship with Buffett.
I actually forgot that she was also mentioned in The Outsiders. I only had the documentary in mind, but you're right. And perhaps because of the success of this Washington Post investment, Buffett found interest in other media companies as well. In 1977, he bought the Buffalo Evening News. And at the time, Buffalo was a two-newspaper city, and Buffett believed that one paper would eventually dominate the entire city. However, the acquisition quickly turned into more or less a financial and also a legal headache as the competitor fought aggressively, and even the regulators challenged the Buffett deal under antitrust laws. And for years, the paper lost money and it drew a lot of criticism to Buffett and his investment style as well. But Buffett and Munger, as they always do, they didn't sell. They were convinced that the local newspaper had inherent monopoly economics. And eventually, the patience did pay off because the competitor just couldn't keep up, and the Buffalo News became the city's only major daily. And with that, economics improved massively as well.
It's fascinating to me that Buffett invested in so many simple companies with these kind of regional focuses. And I mean, there's so many exciting public companies out there doing stuff at the cutting edge of technology. And for most people who aren't wired like Buffett, seeing that gives them a lot of FOMO. And then yet there's Buffett, who became the best investor of all time, in many ways just choosing some of these household name basic businesses that were kind of just around the corner, and whether that's with furniture markets or newspapers. So I do think there's a lot of truth to investing in what you know. And Buffett has never claimed to understand tech, but he certainly understands furniture and newspapers.
And we shouldn't forget, we're talking about Omaha. We're not talking about New York or San Francisco, where, for what it's worth, you have a couple more companies to choose from. But that's also, as you just said, part of your circle of competency, right? In one of our previous episodes, we also talked about the investment in the Nebraska Furniture Mart. It's another example of not only a local investment, but also a very strong female founder with Miss Blumkin. And it would be too much now to go through all of the investments that Buffett made. But in essence, the 80s were a decade when Buffett acquired many strong brands with local customers and outstanding managers. And choosing high-quality managers really was important since Buffett wasn't interested in getting operationally involved most of the time. The general idea was for Berkshire to have a decentralized management structure and provide financial backing and liquidity, and only when managers reach out to him, he would also, of course, offer advice.
You know, that's something our friend Jacob McDonough, who wrote this really excellent book on the history of Berkshire, especially the early history, in this private presentation he gave to our Intrinsic Value community of investors, he brings up that same point. And being a company owned by Berkshire basically gives you the chance to do business more aggressively than as a standalone company. You don't need to be as conservative or to have as much of a safety cushion as other companies, because Berkshire can inject liquidity in these kind of special circumstances where it might be needed. And when you think about the pandemic, for example, it helps to know that you're backed by a company with hundreds of billions of dollars in cash, instead of having to finance your business without really any help in a lockdown. So that's just one small example of how being in the Berkshire ecosystem can be very advantageous and can kind of change the psychology of running your business. But how about we talk about the next pillar of Berkshire and go on to look at their energy business? The move into energy seemed a bit surprising at first. Buffett liked businesses famously with really a limited need for reinvestment. And that is not what the energy industry is. Energy is a very capital intensive business. And yet in 1999, he bought Mid-American Energy for about $2 billion. And later that company was renamed to Berkshire Hathaway Energy, or just BHE, and became one of the most important businesses in the Berkshire empire. So why did they make that investment? What did he like about the company back then? And how is that business doing today?
Interestingly, just a year before Buffett bought Mid-American Energy, he held a speech at the University of Florida, and a student asked him about utility and energy stocks, and this is what Buffett said back then.
What do I think of what? The electric utility industry? Well, I've thought about that a lot because you can put big money in it. And I've even thought of buying entire businesses. There's a fellow in Omaha, actually, that's done a little of that through Cal Energy. But I don't quite understand the game in terms of how it's going to develop with deregulation. I mean, I can see how it destroys a lot of value for the high-cost producer, once they're not protected by a monopoly territory. And I don't for sure see who benefits and how much. I mean, obviously the guy with very low-cost power, some guy's got hydropower, at 2 cents a kilowatt or something like that, has got a huge advantage. But how much of that he's going to get to keep and everything, or how extensively he can send that outside his natural territory, I haven't been able to figure that out so that I really think I know what the industry is going to look like in 10 years. But it is something I think about, and if I ever develop any insights, that call for action, I'll develop, I will act on it. But because I think I can understand the attractiveness of the product, and it's all of that, all of the aspects of certainty, of user need, and the fact that it's a bargain and all of that. I understand. I just don't understand who's going to make the money in it 10 years from now, and that keeps me away.
So while you're right in saying that Buffett up to this point preferred capital-light businesses, he did appreciate just a steady demand and the monopoly-like market structure, and also the ability to invest billions at reasonable and stable rates of returns. So he decided to pull the trigger a year after that speech because he finally felt like he had found the right people. Again, the right management is essential for Buffett whenever he does make an investment. So the company was run by CEO David Sokol and owned by Walter Scott. With the right management, Mid-American Energy, or Berkshire Hathaway Energy, expanded quite aggressively. Today, it's one of the largest owners of wind and solar assets in the US, with over $100 billion in assets.
And Greg Abel, who we know is now Buffett's successor at the top of Berkshire, was actually crucial for that expansion and success, I think. He joined Mid-American in the early 1990s and became CEO of Berkshire Hathaway Energy in 2008, overseeing this expansion into renewables. And I remember there was one question on the energy business and sustainability at this year's meeting. It's been something of a hot topic, you might say.
Yeah, I remember that. It was about the remaining coal operations, I think. And in my opinion, he handled it quite well, although there were some people, at least judged by the reaction in the crowd, who were not fully satisfied with the answer. But the truth is that BHE has reduced its coal operations significantly in the last 20 years. In 2005, coal still generated over 70% of BHE's power. Today, that's less than 30%, and there's a plan to retire all coal plants in the next 25 years. So Berkshire Hathaway Energy today is mostly a collection of 3 large utility companies and then a lot of smaller ones. So the big 3 are Mid-American Energy, as one of them, Nevada Energy, and Pacificorp. Those are the other 2. And in this business segment, you can clearly see the advantage of being part of Berkshire. Since Buffett acquiring Mid-American, the energy segment has never sent a single dollar of profits to Berkshire. All the profits they earn stay within the business to grow the capital base, or they are reinvested into the business. And that's very different for its competitors. Utility businesses, they're not the most attractive businesses for most investors, so they often spend a lot of money on dividends. About 75% of profits, on average, are spent on dividends. And now you have to imagine you are an average energy company paying out 3/4 of your profits to shareholders, and you compete with a company that can reinvest all its money into growth, I guess that's a pretty difficult fight to win, right? And that's pretty much how BHE grew to cover over $140 billion in assets, and that's more than 10% of Berkshire's total assets. That might not sound that much, but these are infrastructure assets, so they throw off predictable returns for decades. The insurance business, for example, has a significantly larger asset base, but it consists largely of financial securities with lower near-term earnings power. And I would say that's the main objective and the power of the energy business for Berkshire, because it just provides the company with a long-term reinvestment outlet, while most other subsidiaries, especially the smaller companies like See's Candy or Nebraska Furniture Mart, they generate excess cash, but they can't use it internally at high returns.
Usually you'd want as much cash for Buffett to be deploying as possible, but Berkshire's cash is already at about $350 billion. So Berkshire is not lacking cash to invest, but they're really lacking investment opportunities. So having some of these capital intensive businesses where you can put tens of billions of dollars to work, generating decent returns, that's actually a kind of a good thing for Berkshire. And a similar heavy asset business is BNSF, Berkshire's railroad business. So what can you tell us about this other capital heavy business that Berkshire has taken on?
So BNSF stands for Burlington Northern Santa Fe, and it's another one of those, as you said, companies that probably wouldn't excite many retail investors, but at some point it was Berkshire's largest deal in company history because Buffett paid $26 billion in cash and stock. It's not an example of Buffett's patience because he followed the industry for decades, but avoided it for a long time because it was kind of overregulated. That just made it a pretty tough business to be in. But by the mid-2000s, the industry has changed quite significantly. Most importantly, the rail system had been consolidated into just a few large players, which basically gave them a duopoly or at least an oligopoly position in their regions. And that's when the industry became much more attractive to Berkshire. And in classic Buffett manner, he used the years around the financial crisis to make his investment. He acquired BNSF for a total of $44 billion, so it was quite a big commitment, I would say. And the investment thesis was really as straightforward as it gets. The system in place is pretty much a barrier to entry in itself. It just doesn't make sense to build more tracks. And so, as Buffett puts it, as long as the American economy will prosper and grow, so will BNSF.
Well, I felt it was an opportunity to buy a business that is going to be around for 100 or 200 years. That's interwoven with the American economy in a way that if the American economy prospers, the business will prosper. It is the most efficient way of moving goods in the country. It's the most environmentally friendly way of moving goods, and both those things are going to be very important. But the biggest thing is the United States is going to do well. I mean,
so as Buffett said, it's just a very effective and also environmentally friendly way to move goods. There's just not that much that can hurt the long-term thesis for railroads.
With Buffett, it always seems so simple. It's like when you watch an NBA game and you see the pros just make dunking look completely effortless. And then, I mean, it's not. Buffett just thinks about what businesses will still be here in 50 years so well, and whether he can predict how much cash those businesses will produce. And you and I have looked at close to 40 companies by now just for this show. And we know firsthand that the idea might be simple, but execution is not. To consistently do this for 6+ decades, I mean, that's incredible. And with railroads, I think he nailed it again. It generates billions of dollars in reliable profits each year. It requires massive infrastructure that, as you said, would really be nearly impossible to replicate today. And then it's diversified in itself in a way. Sure, railroads move with the economy, but their mix of agricultural, industrial, and consumer goods cargo can provide exposures to different parts of the U.S. economy's growth. And so we just talked about coal a minute ago. Coal is actually a large part of what Berkshire's railroad transports. And it'd be easy to say there's a risk there because less coal also means less business for the railroad. But Buffett keeps things really simple and just says, look, railroads are one of the most effective ways to transport any type of good. So they're always going to be used. And if less coal is getting transported, most likely it's just going to get substituted for something else, maybe grain, for example.
It's such a simple framework, but it's hard to imagine it won't be at least directionally right. As long as the economy grows, and perhaps also the population, that's probably also a big factor, you will have more and not less demand for transporting goods. It makes a lot of sense for Berkshire, but it's also true that these investments that won't generate outsized returns. And that's true for Berkshire Hathaway Energy as well as BNSF. But they can consistently generate at least decent returns. And considering that Berkshire has to invest tens of billions of dollars each year and even hundreds of billions of dollars if you consider the cash position, Buffett just needed to find places to invest a lot of capital for a decent and reliable return. And he's kind of doing it on a big scale. And many smaller investors do it on a small scale when they invest in Berkshire, looking for reliable and decent returns. And outstanding returns are what investors in Berkshire hope for when they look at the equity portfolio, which is currently worth still about $250 billion. And that sounds like a lot, and it is, but it is also 100 billion less than in 2023. The portfolio is consisting of about 41 positions, I think, right now. And it might sound like that's a lot considering that Buffett is famous for his concentrated portfolio approach, but the top 10 positions still make up more than 85% of his portfolio. So the portfolio is a lot more concentrated than it looks at first glance.
And looking at the top 10 positions, we see a couple names that he already has owned for decades. American Express is one of those interesting examples. It's Berkshire's second largest position today, and Buffett made his first investment in the company in the 60s at a time when Amex was involved in a scandal, in the so-called salad oil scandal. And it was really more about a company called Allied Crude Vegetable Oil. And this company was using fraudulent accounting and machinery to inflate its inventory of salad oils. And American Express was the company that was supposed to be responsible for checking Allied Crude Vegetable Oil's inventories. And, well, they missed it big time. I mean, they didn't even notice that the amount of oil they said the company had in stock would have actually exceeded the entire oil supply of the United States. And to add insult to injury, for as bad as that sounds, American Express even loaned money to Allied Crude itself and took on some of this fraudulent inventory as collateral. And of course, that severely hurt Amex's balance sheet and reputation. And the stock declined 50%. And some feared, American Express might not survive this. And Buffett used that opportunity as a way to really express his faith in the company by taking 40% of his partnership's money and investing it into American Express. And as we know today, that paid off tremendously.
It's quite an interesting story. And we looked at so many different turnaround stories here on the show. And Buffett is often quoted as saying turnarounds seldom term, and yet he's famous for buying companies in tough times. And in this case, he just believed in the strong brand and customer loyalty, and that the scandal wouldn't have any lasting damage. And I guess what I want to say is that not every turnaround is the same. When we looked at Estee Lauder, for example, we saw a mismanaged company with deteriorating financials and a questionable position for the future. When we looked at LVMH, we had a very strong brand that is struggling currently, especially with demand, but most likely due to macroeconomic factors. And then when we look at PayPal, we have a business that is not even really a turnaround. The overall business continued to grow, but the stock still crashed due to just high expectations in mostly 2021. So what I want to say is there are many different turnaround plays. For anyone who wants to learn about investing, and since you listen to the show, I guess that's true for most of you here, I would highly recommend studying older investments of Buffett, Munger, Greenblatt, all of those great investors. We will soon actually host a call in our community where we will go through some of the early Buffett letters and also analyze his thought and investment process back then. And a case study that's often discussed is obviously Coca-Cola. It's just a great example of how he operates. He initiated his position, I think, in 1987 after the stock market crash, and then he accumulated a position of roughly $1.3 billion in the following years.
The special thing about Coca-Cola is how well that company is compounded. I mean, other quality companies like See's Candy, for example, did well too for a period of time, but Coca-Cola did it on a global scale, which really just has turned it into such a remarkable investment for Buffett over the years. And it wasn't cheap, but trading at a modest multiple in the mid to high teens, despite having a really unrivaled global distribution network, this iconic brand, and a dominant share in the beverage market, made it really an obvious pick for Buffett. And again, the greatest thing about Coca-Cola was the pricing power. I said in one of our last episodes, but I'm pretty confident people will still be drinking Coca-Cola in 50 years. And if that's the case, and Coca-Cola can continue to raise prices in line with inflation, maybe plus some extra, And you don't need much more than that for a really successful investment to pan out.
And by now, Coca-Cola has paid Berkshire multiples of its original cost basis just in dividends alone. I mean, last year, the dividend was $800 million and the equity stake was worth $28 billion. But you have to admit that not all of Buffett's investments paid off that well. In 2015, Berkshire partnered in a relatively unusual manner with the Brazilian private equity firm 3G Capital to finance the merger of Heinz and Kraft Foods. And Buffett is not a big fan of private equity, to say the least, but with few opportunities in public markets, it looked like this deal could have served as a new way to make investments if it had worked out, but it didn't go that well. I mean, Buffett overpaid, and the competitive pressures, I think they were stronger than he anticipated going into that investment. It might be a good example of why Buffett generally likes to work with founders or CEOs directly, because in this deal, Berkshire took more of a financing role, and the private equity firm was responsible for the operational side. And Buffett did say that they were aligned on how to approach it, but at least from the outside, it seemed like a typical private equity deal with a lot of cost-saving measures that eventually compromised product quality and ultimately hurt the brand more than it helped the business. And what followed were several billion-dollar write-downs. To be fair, though, it's not like Berkshire lost a ton of money on Kraft Heinz. Considering the dividends and the value of the stock, the return actually has been about 60%. Annualized, that's about 5%, so well below his usual threshold. But for one of his biggest mistakes, it's bearable, I guess. I mean, the only thing that bothers me is that this is a company that, a young Daniel bought into thinking this couldn't go so wrong if Buffett is in there.
When we talk about Berkshire's equity portfolio, I mean, we can't get around Buffett's most successful investment ever in terms of absolute dollar profits. And that was in 2016 when Buffett bought Apple and pretty quickly made it Berkshire's largest holding.
Apple was actually the one position that overtook Kraft Heinz as the biggest portfolio holding. I mean, Kraft Heinz used to be 20% of Berkshire's portfolio, and only when Apple entered the picture, that has changed. By 2023, Apple made up about 50% of the equity portfolio, which meant that Berkshire owned over $170 billion of Apple stock. And more recently, though, Buffett sold a significant portion of that Apple position. And last year, he sold off half the position. And last quarter, he sold another 20 million shares. And Apple is still the biggest position in the portfolio, but at 22%, it's not as much of an Apple proxy anymore as it has been in the past years. And I don't want to speculate too much, but seeing him sell more of half of his position makes it very likely that he sees Apple as being quite overpriced. I mean, otherwise he wouldn't sell it and add another $70 to $80 billion to his already incredibly large cash position and basically pay tens of billions of dollars in taxes. I mean, he was okay with decent, but not outstanding returns for his energy and railroad investments. So seeing him reduce his Apple stake like that makes me feel like he thought Apple might not be delivering the same returns with the same certainty, at least.
It's hard to argue that Apple isn't richly valued when it's trading at 35 times earnings, even though it has really only hardly grown profits for years. I think its earnings CAGR is like 1 or 2% for the last 3 years. And it's pretty clear that only so much more can be squeezed out of iPhone sales, which is the company's golden goose. And, I've heard some speculation, though, that Buffett was also sitting on such substantial capital gains in Apple shares that he almost wanted to maybe lock in that profit today at a relatively lower tax rate. And so obviously I'm entirely speculating, but we've all heard the headlines about America's growing budget deficit, and it's something that Buffett has spoken out against for really years now. So I think he does have a legitimate concern that over the coming decade, taxes could have to rise meaningfully to offset some of that deficit spending. And if so, higher capital gains taxes on investments is probably one of the first levers that gets pulled to help with that. And really the point being, between having a mature business at a very rich valuation and then having substantial capital gains on that could be subjected to much higher tax rates in the future, I think it does make a lot of sense for us to why Buffett would want to start trimming that position, even if there is that old adage about not trimming the flowers to water the weeds. And Apple has been quite a beautiful flower for Berkshire shareholders. But at some point, you do need to reap the benefits of that flower. And I think the investment case is just really not as strong as it was a decade ago. So selling billions of dollars of Apple when you already have hundreds of billions in unallocated cash, that just opens the door to questions about opportunity costs and really what would be better to invest that cash in instead. And the reality is that we have not had a meaningful bear market since 2009. So the market is arguably as richly valued as it has ever been. And I feel like we've heard that for years now, but it's true. And due to the law of large numbers, there's only maybe a small subset of maybe like 100 of the biggest companies in the US that could even really move the needle for Berkshire as potential investments, with that subset obviously being further limited by valuation and business quality. So there's really only a handful of companies that Berkshire Hathaway can invest meaningful amounts of capital. And the best thing for Berkshire would be a sustained bear market. They created more opportunities to deploy their cash. And with something like 50% of our portfolio sitting in cash, Daniel, you could probably say that our intrinsic value portfolio would benefit from that in the same way. But to not go on that tangent, let's get to the last major part of the Berkshire Hathaway business, which is the manufacturing, service, and retailing.
In sheer scope, this is actually the largest collection of businesses inside Berkshire, not insurance or railroads. In this segment, you can find everything from industrial giants to furniture stores to jet services. And last year, it produced over $13 billion in profits, which is over a quarter of Berkshire's overall operating profit. And manufacturing is by far the biggest piece, and it's divided into three bigger product categories, and that's industrial, building, and consumer products. And for obvious reasons, we won't go over all the businesses now, but there are some that stand out, and I think investors of Berkshire should just know them. On the industrial side, that would be Precision Castparts, which is the largest holding, and it is a leading maker of aerospace components. And this was one of Buffett's largest acquisitions ever. He bought it for $32 billion in 2016. And Buffett actually said himself that this price has probably been a bit overly optimistic. And during the pandemic, PCC faced some serious headwinds as aircraft orders collapsed, and the company still came out on top just because it had a strong competitive position and thus remains strategically important, especially to the big buyers. So they supply to Boeing, Airbus, and also the defense industries. Beyond PCC, you have companies like Lubrizol Corporation, which is one of the largest manufacturers of specialty chemicals. You have Iska, which is a manufacturer of metal cutting tools, and Marmon Holdings, which operates in a wide variety of segments. And one thing they all have in common is that they operate in industries with relatively few competitors and reasonably high barriers to entry. And with the financial flexibility of being backed by Berkshire, I think this leaves them in a pretty good position to be in. And in building products, it's kind of similar. It's like a who is who of American housing and construction. And Clayton Homes is the largest US producer of manufactured housing and also runs a mortgage business. Shaw Industry makes carpets and flooring, and Jones Manville produces insulation and roofing materials. And Mytech supplies building components and software. There are just so many companies you could go into, but again, they all pretty much have the same playbook as with the industrial businesses.
I think every year when we walk into the shareholder convention, we're always just blown away by how many different businesses there are that I'm almost embarrassed to say I've never heard of them. There's always a company every year where you walk in and you're like, oh, I didn't know they belonged to Berkshire. Dairy Queen? Didn't realize that. And just really shows you how ridiculously big and complex the company has become as a conglomerate. And, you know, we've looked at other trillion-dollar businesses with Amazon and Alphabet before, but even there's 2, 3, 4, 5 really core businesses. And Berkshire is just on another level because there's so many different businesses that they own. And yet with this business segment, for example, all that diversification doesn't really help them in a recession, I don't think. When there's a slowdown in the housing market, I think all the businesses you just mentioned are going to struggle. And just a few months ago, I personally was seriously looking at buying my first house. And it was really exciting, but it was hard to justify doing so with rates being where they are. And with that, the fact that the housing market really hasn't cooled off much either. So maybe that's my value investing perspective leaking into real world decisions. But I'm sitting here, I'm looking at these homes. I'm like, hey, it's kind of a hard pill to swallow that some of these starter homes at $300,000, maybe in 2020, are now selling for more than $500K. I mean, that's just 5 years. And you're talking about prices having nearly doubled or doubled in many cases, especially in the market I live in. And so those kinds of gains in home prices over the last decade are really almost certainly not sustainable, I'd think, over the next decade. So there's a real risk of a reset in housing that, again, ripples across Berkshire's businesses. But of course, that's just me speculating on macro. And Daniel, I know we try to make a point on the show of not speculating on macro because it's really most often kind of a waste of time to spend it thinking about what ifs in these different scenarios. But anyways, long term, I think it has been great that Berkshire has been levered to the fate of the US economy. But that also means it's not immune from recessions and housing slowdowns either, especially in this segment.
Buffett loves to praise, being born in the US and investing in the US and all that. I think that's also one of the things we talked about after the shareholder meeting, but it just paid off so well for him, right? All of these companies have strong market positions, and with the backing of Berkshire, they don't necessarily have to worry about not surviving in cyclical downturns, even if they come. It's just a good example of how Berkshire can be a structural advantage for the companies it owns. And eventually, of course, that is an advantage for Berkshire itself again. It kind of reminded you, as you told me, of Comfort Systems, a company we also covered on the show many episodes back. And it's similar on the consumer side, right? I remember when we entered the convention, and you just mentioned it, at this year's annual meeting, it was my first time being there. And I saw so many companies that I didn't even know were owned by Berkshire. One of them was Forest River RVs. We were standing there in front of this huge motorhome and a boat next to it. And actually, Buffett gave an interview with the founder of that company just a couple of minutes after we stood there and looked at it. And Forest River is one of the many consumer-facing manufacturing companies that 90% of Berkshire shareholders probably never really noticed. And it's been part of Berkshire for 20 years now, and it's a great example of one of the quiet compounders within Berkshire, and also Buffett's emphasis, once again, on management. In his 2024 annual shareholder letter, he told the story of how he met Pete, who is the founder and still the CEO of the business, and basically decided over just one dinner to buy the company.
I think to some people that would really sound reckless, but there are so many of these stories, and a lot of his most successful investments felt like these moments where he's betting on the founder more than the actual business itself. And, when you have 80 years of experience in business and assessing management teams, I do think you get a feel for people that is maybe a bit of a competitive advantage for him. And it's not only a feeling, though. I mean, Buffett also looks a lot at incentives. And so, is the founder only profiting when the shareholders benefit, or are they making money regardless, as is really often the case across Wall Street and with most major corporations. And as you know, Daniel, Berkshire's compensation structure is highly aligned with shareholders. And really the entire company structure is one of a kind. Maybe it's just me, but I don't know any other trillion-dollar companies in corporate America with really no centralized budget, no HR, and really as little corporate bureaucracy as humanly possible for a company of that size.
Berkshire is just as unique as it gets in terms of having no HR, having no corporate bureaucracy, all of that. I mean, you pretty much have about 30 people at the headquarters in Omaha, and that's it. Munger once put it perfectly with this typical wit, so let's listen to that.
Yeah, the truth of the matter is that we have decentralized power in the operating businesses to a point just short of total abdication. And we don't think our system is right for everybody. It has suited us and the kind of people that have joined us. But we don't have criticism for other people like Emerson Electric or something who have.
As I said, this works because, above all, Buffett and Munger paid attention to the character of the people they work with. We all know Buffett's saying, and looking for people to hire, you look for three qualities: integrity, intelligence, and energy. And if they don't have the first, the other two will kill you. And no matter what founder story you go through, you will always see that the people Buffett chose were clearly honest people. That was true for Pete Legal from Forest River, for Rose Blumkin from Nebraska's Furniture Mart, and also for Chuck Huggins from See's Candy. And Buffett and Munger themselves, as you kind of mentioned, famously only earned $100,000 per year. There are no stock options, no performance bonuses, and no other perks. If Berkshire is doing well, Buffett is doing well, and it's the same for every other shareholder of the company. And since it turned out that Buffett was quite good at allocating capital, well, that turned out to be quite well for everyone involved in the business. And talking about capital allocation, I think we can skip the obvious, which is that Berkshire invests a lot of the money its businesses generate and then send to Omaha into stocks. Beyond that, though, Berkshire occasionally repurchases its own stock, but only when Buffett and perhaps in the future Greg Abel think that Berkshire stock is undervalued. Interestingly, Berkshire didn't buy back a lot of stock recently, which might indicate that Buffett himself didn't think or is not thinking that Berkshire is hugely undervalued. And very significant repurchases happened back in 2020 and 2021 when Berkshire bought back shares worth about $60 billion.
Considering that Buffett isn't buying other stocks either, which could have indicated that there are just simply some better opportunities in the market right now, I guess it's likely that he's going to wait for a better opportunity to buy Berkshire too, with the stock trading at a multiple of about 14.5 times operating profits. But before we get to the valuation, and you tell us whether you think Buffett is right about the valuation of Berkshire, which I'm sure he maybe knows a little bit more than us, how about we talk about the elephant in the room? And that's Buffett's retirement and Greg Abel as the new CEO. And naturally, the older Buffett got, the more people have speculated what happens when Buffett steps down. And at the 2021 shareholder meeting, Charlie Munger kind of gave that answer away. A question from the audience was about whether Berkshire might be too difficult to manage for a single person who is not Buffett or Munger, to which Buffett replied that Berkshire is already so decentralized, it only works with the right culture. And then Munger added in that we do have that culture and Greg will keep it. And since then, we know Greg would basically be the one to follow Buffett. After this year's annual meeting, we also now know the timing of when that will happen. So how do you think about this? Do you think it can impact Berkshire's performance in the future to have this change? Or is the company so decentralized and set up for success that for the next 5-10 years, it really doesn't matter?
Honestly, I'm not completely sure. Generally speaking, I'm not concerned. I do believe that Berkshire's culture has been the main driver of business success for Berkshire, especially in the recent past, where Buffett's capital allocation skills were less of a factor in the company's returns. And Abel knows that culture like few others do. He came up through the ranks through Berkshire's energy division and has worked closely with Buffett for about a decade now. What gives me a little pause, though, is that I know so little about his skill set. I remember that there was a question this annual meeting on what makes Greg Abel so special. And like I mentioned to you afterwards, I didn't find the answer too inspiring. He was basically just reassuring that Greg is the right guy and a good fit. But knowing that only an hour later he would tell us Greg is the new CEO, I think he could have used that opportunity to just be a little more precise. I mean, Greg has to follow in the footsteps of one of the best to ever do it. And we know how much emphasis Buffett puts on choosing the right people to work with. So while I trust him, I would have liked to get a better idea of why exactly he chose him. That said, a couple of years back, Buffett did give Greg credit for his capital allocation skills, for example, and we see that in the video here.
Well, the answer is that Greg, I'm going to turn it over to him, but the answer is Greg understands capital allocation as well as I do. And that's lucky for us. And he will make those decisions, I think, very much in the same framework as I would make them. And we've laid out that framework now for 30 years.
To the extent that uncertainty from Buffett stepping down gives us chances to buy Berkshire at attractive prices, I'm all for it because I do think the company can persevere for years to come, which gives us ample time to assess Greg as a capital allocator too, and really as a manager of the business. And I don't think going forward, we should be blindly loyal to Berkshire just because it is, Berkshire. But also, it's not like the portfolio of companies built up over the past 60 or 70 years is just going to disappear the day that Buffett steps down. And now, though, to move along a bit, how about we go over to the valuation and use that to cover the financial side of the business in a bit more detail and just think about whether we want to actually add Berkshire to our intrinsic value portfolio.
Well, today we changed it up a bit because instead of doing a DCF, I chose to go with a sum of the parts valuation. For a company like Berkshire, which is so diversified, I think that's probably appropriate to do. And so for the sum of the parts, we mostly look at the balance sheet and then later at the capitalized earnings for some of the operations. So we start by looking at cash. I only count the cash that is under the insurance and other part of the balance sheet. What I do not count is the cash from BNSF, utilities, and energies. Because as we discussed, they're capital-intensive businesses and they reinvest their earnings and the cash instead of sending it to Omaha. If Berkshire can't really use that cash, we shouldn't count it, at least in my opinion. At least not here. I mean, of course, it is still part of the valuation because when we look at the capitalized earnings, since it is still put to work for Berkshire, we will see how it impacts the valuation, just not directly through, Buffett allocating that capital. After cash, we add the fixed maturities that Berkshire owns, which can also be found on the balance sheet, and combining that, just cash and bonds, they alone are worth already more than a third of Berkshire's current $1 trillion market cap.
All that cash, I think, raises the stakes for Greg. I mean, it would be one thing if Greg were inheriting a situation where he didn't have to do much for the time being, but he'll likely feel the pressure to make some big decisions relatively soon. There's a lot of capital to be allocated. And ideally, that would have been done by Buffett before a handoff. But of course, Buffett is not going to do that if there aren't sufficiently attractive investments available for him to pour that cash into.
Well, as you said prior, we're in one of the longest bull markets in history, and the set of companies Berkshire can invest in is already small. So either we see a shift with more tech investments in the future. I mean, we've seen that with Snowflake before, for example, which was definitely not a Buffett investment, or we will have to wait for a potential bear market to see the capital being deployed in some equities. Speaking of which, let's talk a bit about the equity portfolio. I mean, you can make valuing this part of the business as complex as you want. Berkshire is reporting the value of its equity portfolio and its filings, and I would suggest most of the time you just go with that number. However, you should also be mindful of stock prices. If you think a large holding is massively over or also underpriced, you should adjust for that in the valuation. So for example, when Apple was still a 50% position in Berkshire's portfolio, I would argue it would have made sense to value Apple itself and then adjust the value in Berkshire's portfolio based on what you think Apple is actually worth. Since Apple has corrected quite a bit since its all-time highs and is now only a little more than 20% of Berkshire, pretty much in line with American Express, I keep it on the books unchanged. For the record, if it still would be a 50% position, or if you want to go really into the detail, I would have adjusted the value downwards a little bit.
So you're not making any adjustments for the equity portfolio?
Not in terms of equity values, no. But I do adjust for taxes that Berkshire would need to pay on unrealized gains if it were to realize those gains by selling equity. So you mentioned that in Apple's case, he might have paid less than the usual tax rate, but for my model, I use the 21% casual tax rate, and that would result in about $40 billion now for the entire unrealized gains of the portfolio.
Okay. So where are we now? I mean, we have about $350 billion through cash and cash equivalents and bonds. And then looking at your model, it looks like you've got another $230 billion for the equity portfolio. So that takes us to $580 billion of Berkshire's valuation already. And we haven't even talked about the railroads or the utility businesses.
And we also haven't talked about the equity method investment. Those are basically the companies which Berkshire owns more than just a small piece of the business, but also not all of it. So that's where you can find companies like Kraft Heinz or Occidental Petroleum, for example. And these are accounted for as if Berkshire would own the entire company. So instead of reporting it mark to market, Berkshire just reports its share. So for the last 12 months, that share was about $25 billion. And again, you can just find that number on Berkshire's balance sheet.
The great thing about Berkshire is that its reports are so well structured. It's a complex business, but you can find most things relatively quickly, and in contrast to some other companies where you sometimes feel they add complexity just for the sake of doing so, and maybe so investors can't fully follow the business. Berkshire really tries to make it as easy as possible to follow along.
That's true. And I mean, some companies like BNSF, for example, they even still release their own filings and annual reports. It's kind of mind-boggling to think about how many companies Berkshire owns that would literally be worth tens of billions of dollars and would sometimes even be Fortune 500 companies. But within Berkshire, and you look at the annual reports, they're sometimes just more or less a footnote. BNSF is definitely not just a footnote. It has an average earnings power of about $5 billion a year, and it's not growing by a lot. But due to its mode and stable earnings, I think a multiple of 15 for their business is probably fair, and that would result in a value of about $80 billion. And I give the same multiple for Berkshire's energy business, which also leads to a valuation of about $55 billion. And this valuation is quite interesting because Buffett bought Greg Abel's 1% stake of the business just 3 years ago. And BHE's implied valuation in that deal would have then been $90 billion. That could make you think that $55 billion is way too low for valuing the energy business. However, about a year ago, Berkshire bought the remaining 8% stake of the business that it didn't yet own. And that deal only had an implied valuation of the energy business of about $50 billion. So a lot closer to our estimate here and over 40% below the 2022 valuation.
Considering there are only 2 years between the deal with Able and then the acquisition of the rest of those Berkshire Energy shares, either Greg made an incredible deal or Buffett did when he bought the rest of the company. And I mean, I don't believe that Buffett would have given Greg any form of special deal. He's known for always acting in the best interests of the common shareholder, and paying Able double what his stake is worth doesn't sound like that. And I think really what happened here is that the wildfires that we've seen in the past 2 years have impacted the value of the energy business really severely, especially with that increased regulatory scrutiny that comes with that. And so Buffett himself mentioned in an annual filing last year that the intensity and frequency of those fires increased and will continue to increase. And the cost that arose for Berkshire Energy can really only be estimated in the years to come, but it's substantial. And he's even said that they're sort of in survival mode for some of these energy companies. So it's not unreasonable to think the valuation of the energy operations has really been severely impacted by all of this wildfire stuff.
Yeah, that could definitely be the case. I mean, we mentioned how regulation impacted the railroad industry in the past, and that for the longest time, it wasn't an attractive place to invest in. And it's similar for utilities, and perhaps after some decades of more or less favorable regulation, this will change for energy in the future. And that would be a worst case scenario. And if we're just talking about a more difficult time for companies in the space, I would still personally bet my money on Berkshire coming out on top of that. But it's still a risk that we have to face. I just don't think any other company in the industry is as good at assessing risks as a company that quite literally is a huge insurance conglomerate. And speaking of insurance, there are only two businesses left in our sum of the parts valuation, and that's insurance and the entire manufacturing, service, and the retail block. So I would start with the manufacturing business. I think the manufacturing segment makes about, as I said, $13 billion in earnings per year. And again, I will put a 15 times multiple on that, which leaves us with about $200 billion as a price tag for that business. Fun fact, we only own one company right now in our intrinsic value portfolio that's worth more than that, and that's Alphabet. All other companies are worth less than Berkshire's manufacturing business alone.
It's funny because we took a sum of the parts approach with Alphabet too. And it's interesting that with Berkshire, some of these companies may be worth more on their own, especially if the market no longer pays the same premium for Berkshire stock that it did for years while Buffett was at the helm. And with Alphabet, for better or worse, I do think thanks to the big data synergies that they have and from AI, there's actually probably more of an implicit bet that the whole thing is worth more than the sum of its parts, because data from Google search and YouTube, for example, can be used to support other parts of the business, which is why, in my opinion at least, the conglomerate valuation for Alphabet is actually very reasonable and attractive, because I think there are a lot of these internal synergies that are hard to quantify, but add to the company's overall value in a way that you don't see with a conglomerate like Berkshire.
I do agree. We just recently had the talks about selling Chrome potentially for $35 billion to Perplexity, and I think something like that would hurt Google way more than any one subsidiary leaving Berkshire. Although I would argue that this is also the case with many companies within Berkshire as well. It might feel like a Buffett premium that was paid by investors for a long time, but I think of it more as a Berkshire premium. As we mentioned, the financial backing by Berkshire is a huge advantage, especially in difficult times or recession. And there are many businesses that I personally wouldn't buy as a standalone company, but within Berkshire, I think the risks are much more limited. So I think there's also a synergy going on in Berkshire that doesn't only represent, a Buffett premium. All right, I think that leaves us with the insurance business, or better said, the insurance underwriting business, since the insurance business is how cash, bonds, and equity investments are funded, and we can't just add a balance sheet value of the insurance business to our sum of the parts, because otherwise, if we did that, we would just count all of the investments again. So instead, we are looking at the underwriting business and its earnings, and Berkshire is one of the, as we just said multiple times in this episode, one of the few insurance companies that actually turns a profit on their underwriting business. So there is some volatility in the earnings, but particularly over the last years, the business has performed quite strongly, earning about $9 billion in underwriting profits, and that's an implied underwriting profit margin of about $10, which is really an exceptional result. And that's probably not a sustainable margin in the long term, but it's still is if it's only half of that. I mean, Adam Mead, for example, who does a phenomenal job of reporting on Berkshire, and I've linked to some of his sources and his work in the show notes, he assumes a 4% profit margin on underwriting in the long term. I think that's a fair assumption. I personally went with 5% looking at the more recent historical numbers, but I would say the difference is trivial. Generally, in a complex business like Berkshire, there are many times when you have to make an assumption or adjustments that other people just may not make. Buffett once argued that Geico, for example, is probably worth more than its underwriting profit and the float combined just due to its margin profile and its growth outlook. And this time, I put a multiple of 12 on those earnings because 15 would be, in my opinion, too much for an insurance company, even one that is superior to its competitors and backed by the entire ecosystem of Berkshire. So that leaves us with a price tag of $53 billion for the insurance business. And if you compare that to a year prior, as I said, because they actually earned a 10% margin, you could argue that this business is worth $100 billion if they keep that margin going. But I would say that's probably not sustainable in the long term. So now, as the last part of the model, we only have to subtract the debt that Berkshire holds at the parent company level. So you can find that at the parent's balance sheet, and that number is about $20 billion, which means that after all this, and I guess it was quite a long process, we end up with a fair value of almost $975 billion. Compared to today's prices, that would indicate a slight overvaluation of, let's say, 5 to 6%. But looking at it from a price to book angle, you could also make the argument that Berkshire seems slightly cheaper right now than it did in recent years.
I'll be honest, I've never been one to focus too much on price to book because it's not as useful of a metric as it used to be. And as a multiple of operating profits, Berkshire does actually seem to be trending slightly below the median valuation the market has paid for the stock since 2019, which is not nearly as precise of a framework as what you've done, Daniel, but it kind of works. The point being is that the stock is probably about fairly valued, with a case to be made that it's maybe slightly overvalued, but also reasonable people could say that it's slightly undervalued. And either way, at current prices, we are not buying a stock that is obviously a home run where we'd be expecting to dramatically outperform the market. And on the other hand, though, we often like to joke that Berkshire is kind of a backdoor way of getting a diversified index fund without any of the management fees and with some of the best capital allocators who have ever lived sitting at the top of it. So through that lens, it feels like a bet on average returns with maybe less business and valuation risk than the S&P 500 currently, and no management fees as you'd normally get through an ETF or mutual fund. And that is really how I would think about investing in Berkshire at these levels. And until we can find better opportunities, it may not be a bad placeholder to have Berkshire in the portfolio as an alternative to having such a large cash position. Not to say we should put all our cash into Berkshire, but maybe a chunk of it could be a good idea. But with that, let me ask you, where does that leave us, Daniel? I know that some legendary investors like Norbert Liu use Berkshire stock in a similar kind of way as like a placeholder. And I would personally be comfortable with doing that for part of our portfolio where we treat Berkshire shares in particular as sort of almost a flexible form of cash that we could sell as needed to roll into higher conviction bets. Because we know also there's not going to be a huge amount of volatility in Berkshire stock. So we're not taking on a ton of risk by swapping some cash into it and then maybe needing to sell some of it down the road if we had to.
Right. I mean, sometimes you say it's a cop-out when we do not immediately decide on adding a position to the portfolio at the end of our podcast and refer to it, for example, to the newsletter. And sometimes I look at the portfolio of other super investors, and when I see a huge position in Berkshire, I feel like they use it as a cop-out. I don't want our portfolio to become anything like a Berkshire proxy just because it's an easy decision to make. Having said that, we still have, as you mentioned, quite a sizable cash position, and in theory, that would earn only about 4%. Berkshire, on the other hand, can almost guarantee you a market-like return with the optionality of a $350 billion cash position and some of the most skilled capital allocators on top of the company. So the more positions we have in our portfolio, the more we have to think about opportunity costs and comparing one position against the other one. But right now, I believe adding Berkshire, similar to what Norbert Liu is doing or has been doing, is pretty much a no-brainer. So now we only have to think about what is the appropriate positioning. Is it 10%? Is it 15%? Where do you stand on that?
I think starting at 10% is reasonable. And as long as Berkshire doesn't get excessively overvalued for a period of time, We can always add to that if we feel like, okay, we're not finding as many opportunities to double down on or new investments to make. We can kind of allocate more to the Berkshire bet accordingly. But 10%, given that about half of the portfolio is cash, taking a fifth of that cash and putting it into Berkshire, I think that feels about right because it still leaves us plenty of cash to use for other purposes. So yeah, I don't know. Tell me, how do you think about that?
It sounds good to me. I personally use and see Berkshire kind of as a hedge as well. Not necessarily because it wouldn't go down in a cyclical downturn or in a recession, but just because it's a company that's so safe that you can be very comfortable putting your money into the company at a time like that. I always still remember buying Berkshire when COVID happened, and there were probably a lot of companies that outperformed it afterwards, but I was very confident that I could put my money into Berkshire at a time like that and I'd be safe. It's probably a good return as well. It performed pretty well in that time horizon. So I think putting down 10%, and if we do see the market going down more significantly and Berkshire is doing so as well, we could up that position to 15%. So I think that's a good compromise to take here.
I mean, we're taking cash and then we're putting it into something that if a third of the market cap is cash, we're actually still keeping a decent exposure to cash, even by allocating to Berkshire stock.
That's a very good point. That's a very good point too. But perhaps I wouldn't want to bet on it, but I would just think the capital allocators on top of Berkshire might even do a better job than the both of us. All right. With that, how about you give us your hints for next week's episode?
So actually next week's pitch will kind of be similar in structure. It's a diversified business in a way with royalty-based revenue streams that make its earnings very consistent and high quality, actually arguably more consistent than Berkshire's. And so it's probably a fairly valued stock like Berkshire. But again, the question is, will it still be worth adding to the portfolio as something that helps form the portfolio's foundation and as something of maybe an alternative to just sitting so much in cash still? And I would also say, for anyone really looking for specific hints about the company, the CEO is pretty famous in his own right, and he gets referenced in music frequently. Usually in hip hop is where I've heard it, and that's because of the role that his company takes on in the industry, if that makes sense. But I think that's all I'll say for now. Okay, actually, I'll give maybe one last hint. A pretty famous investor came out a few years ago in support of the stock and still holds it. But now I'm maybe giving away too much.
Maybe, but I still think it's kind of a guessing game. I just wanted to give another hint, but I won't do it. Maybe then it's too easy. Okay, so of course I brought a Buffett quote today to end the episode. Anything else would have been unacceptable today. So Buffett said, quote, "Nobody buys a farm based on whether they think it's going to rain next year. They buy it because they think it's a good investment over 10 or 20 years. And we buy Berkshire because we believe the same will be true for the company, even if Warren Buffett is not the person sitting as the CEO at the next annual shareholder meeting anymore." And with that said, have a great day and see you all next week. And for one, these are inherently strong business models. They're asset light, they're easy to scale, and with ample room for expansion. And another reason is that the ones we own have come down in price and valuation a lot due to concerns about the possible disruption of their business model. And that's why I see the next big narrative in our portfolio, Alphabet, Adobe, and Uber. All those are companies that trade at low or reasonable prices because of megatrends like AI or AVs, and they are supposed to hurt their business model. And for all three companies, we argue, as you've heard in this episode, that in fact they are beneficiaries of these megatrends, or in Alphabet's case, at least not in as much danger as the market currently believes